Great. Thank you, Deborah. Good morning, everybody. I'd like to call this meeting of the FDIC Board to order. We have no items on the summary agenda this morning. We have one item on the discussion agenda. It is a memorandum and resolution relating to the notice of proposed rulemaking on a special assessment pursuant to a systemic risk determination. Mike Spencer, Pat Mitchell, Shika Kapoor, and Mary Peterman will present the case if they'd come forward. Mike, you're leading the honors?
Yes, sir.
Okay.
Good morning, Chairman Grunberg and members of the board. Today, we are providing for your consideration a notice of proposed rulemaking to impose a special assessment as required by the Federal Deposit Insurance Act, or FDI Act, to recover the loss to the Deposit Insurance Fund, or DIF, arising from the protection of uninsured depositors in connection with the systemic risk determination announced on March 12, 2023, following the closures of Silicon Valley Bank and Signature Bank. For background, on March 10, 2023, Silicon Valley Bank was closed by the California Department of Financial Protection and Innovation, followed by the closure of Signature Bank by the New York State Department of Financial Services on March 12, 2023. The same day, the Secretary of the Treasury, acting on the recommendation of the FDIC and the Federal Reserve, and after consultation with the President, invoked the statutory systemic risk exception to protect all depositors in connection with each of the two failures. By statute, the FDIC is required to recover through one or more special assessments any losses to the DIF incurred as a result of the actions taken by the FDIC pursuant to the determination of systemic risk, which in this case was to protect uninsured depositors. The FDI Act provides the FDIC with discretion in the design and timeframe for any special assessment to recover the losses to the DIF as a result of the systemic risk determination. In recommending this proposed special assessment, and as required by the FDI Act, staff considered the types of entities that benefited from the action taken or assistance provided under the determination of systemic risk, economic conditions, the effects on the industry, and such other factors deemed appropriate and relevant. In total, of the $18.5 billion in estimated losses at the two banks, the estimated loss attributable to the protection of uninsured depositors was $15.8 billion. These loss estimates will be periodically adjusted as assets are sold, liabilities are satisfied, and receivership expenses are incurred. The proposal would impose an annual special assessment rate of approximately 12.5 basis points. The special assessment rate was derived by dividing the current loss estimate attributable to the protection of uninsured depositors by the proposed assessment base calculated for all insured depository institutions, or IDIs, subject to the special assessment as of December 31st, 2022. The resulting rate is then divided by 2 to reflect the 2-year or 8-quarter collection period. The special assessment rate is subject to change prior to any final rule, depending on any adjustments to the loss estimate, mergers or failures, or amendments to reported estimates of uninsured deposits. Under the proposal, an IDI's assessment base for the special assessment would be equal to estimated uninsured deposits reported as of December 31st, 2022, adjusted to exclude the first $5 billion, applicable either to the IDI, if an IDI is not a subsidiary of a holding company, or at the banking organization level, to the extent that an IDI is part of a holding company with one or more subsidiary IDIs. If an IDI is part of a holding company with one or more subsidiary IDIs, the $5 billion deduction would be apportioned based on its estimated uninsured deposits as a percentage of the total estimated uninsured deposits held by all IDI affiliates in the banking organization. In general, large banks with large amounts of uninsured deposits were the principal beneficiaries of the systemic risk determination. The largest banks also benefited the most from the stability provided to the banking industry under the systemic risk determination. Therefore, under the proposal, these banks would be charged a special assessment to recover the losses to the DIF resulting from the protection of uninsured depositors, with banks of larger asset sizes and that hold greater amounts of uninsured deposits paying a higher proportion of the special assessment. Based on data reported as of December 31st, 2022, staff estimate that 113 banking organizations would be subject to the special assessment. Additionally, staff estimate that banking organizations with total assets over $50 billion would pay more than 95% of the special assessment. No banking organizations under $5 billion in total assets would be subject to the special assessment. As proposed, the special assessment would be collected beginning with the first quarterly assessment period of 2024. The first payment would be at the end of the second quarter of 2024. In order to preserve liquidity at IDIs and in the interest of consistent and predictable assessments, the payments would be collected over 8 quarters. Again, the estimated loss attributable to the protection of uninsured depositors pursuant to the systemic risk determination is currently $15.8 billion. However, loss estimates for failed banks are periodically adjusted over time as receivership operations are executed. The exact amount of losses incurred will be determined when the FDIC terminates the receiverships. If, prior to the end of the 8-quarter collection period, the FDIC expects the loss to be lower than the amount it expects to collect from the special assessment, the FDIC would cease collection once it has collected enough to recover actual or estimated losses. Alternatively, if at the end of the 8-quarter collection period, the estimated or actual loss exceeds the amount collected, the FDIC would extend the collection period over 1 or more quarters as needed to recover the difference between the amount collected and the estimated or actual loss at a rate that would not exceed the quarterly special assessment rate applied during the initial 8-quarter collection period. In the event that the receiverships terminate after the initial collection period and any extension, and if the final loss amount exceeds the amount collected, the FDIC would impose a one-time final shortfall special assessment. While the FDIC would collect the estimated loss over the initial 8-quarter special assessment collection period, under generally accepted accounting principles, applicable banking organizations may recognize an expense for the special assessment immediately. Because of this, it is assumed that the effects on capital and income of the entire amount of the special assessment to be collected over 8 quarters would occur in 1 quarter only. For applicable banking organizations, staff estimate that the proposed special assessment would result in an average 1-quarter reduction in income of 17.5% and a decline in the dollar amount of Tier 1 capital of less than 1%. No banking organizations are expected to fall below the minimum capital requirement of a 4% Tier 1 capital to assets ratio as a result of this proposal. A number of different alternatives for the design of the methodology were considered, but it's staff's view that the proposal presented best achieves the goal of applying a special assessment to the types of entities that benefited the most from the protection of uninsured depositors provided under the determination of systemic risk. Moreover, the proposed methodology is transparent and simple and allows for the special assessment to be collected over an appropriate period of time in order to mitigate the liquidity effects by requiring smaller, consistent quarterly payments. Finally, staff recommend that the board approve and authorize publication of this notice of proposed rulemaking to impose a special assessment with a 60-day comment period. Thank you for your time, and we're happy to answer any questions that you may have.
Thank you, Mike. That was very helpful. I have a brief statement, and then I'll turn to the other members of the board. The FDIC board is considering today a notice of proposed rulemaking to implement a special assessment to recover the loss to the Deposit Insurance Fund from actions taken to protect uninsured depositors pursuant to the systemic risk determination announced in March of this year. A special assessment in such circumstances is required by the Federal Deposit Insurance Act. Following the failures of Silicon Valley Bank on March 10th and Signature Bank on March 12th, the FDIC was appointed as the receiver for both institutions. On March 12th, the Secretary of the Treasury acting on the recommendations of the FDIC and the Federal Reserve, and after consultation with the President, determined that the FDIC could use systemic risk authorities under the Federal Deposit Insurance Act to protect uninsured depositors in resolving those institutions. The proposal before the FDIC Board today would apply an annual special assessment rate of approximately 12.5 basis points to an assessment base that would equal an insured depository institution's estimated uninsured deposits, reported as of December 31, 2022. For insured depository institutions that are not part of a holding company, the first $5 billion in estimated uninsured deposits would be excluded from the assessment base. For insured depository institutions that are part of a holding company, the first $5 billion of the combined banking organization's estimated uninsured deposits would be excluded. Defining the assessment base in this way would effectively exclude most small banks from the special assessment. In implementing the special assessment, the law requires the FDIC to consider the types of entities that benefit from any action taken or assistance provided, as well as economic conditions, the effects on the industry, and other factors deemed appropriate and relevant. In general, large banks with large amounts of uninsured deposits benefited the most from the systemic risk determination. As proposed, it is estimated that a total of 113 banking organizations would be subject to the special assessment. Banking organizations with total assets over $50 billion would pay more than 95% of the special assessment. No banking organizations with total assets under $5 billion would be subject to the special assessment. The total amount collected for the special assessment would be approximately equal to the losses attributable to the protection of uninsured depositors at both Silicon Valley Bank and Signature Bank. These losses are currently estimated to total $15.8 billion. As with all failed bank receiverships, this estimate will be periodically adjusted as assets are sold, liabilities are satisfied, and receivership expenses are incurred. In order to preserve liquidity at insured depository institutions and in the interest of consistent and predictable assessments, the special assessment would be collected over 8 quarters. Because the estimated loss to these receiverships will be periodically adjusted, the FDIC would retain the ability to cease collection early, extend the special assessment collection period for 1 or more quarters beyond the initial 8-quarter collection period, or impose a final shortfall special assessment on a one-time basis after the receiverships for Silicon Valley Bank and Signature Bank are terminated. Assuming that the effects on capital and income of the entire amount of the special assessment would occur in 1 quarter only, it is estimated to result in an average 1-quarter reduction in income of 17.5%. The proposal before the FDIC Board applies the special assessment to the types of banking organizations that benefited most from the protection of uninsured depositors, while ensuring equitable, transparent, and consistent treatment based on amounts of uninsured deposits. The proposal also promotes maintenance of liquidity, which will allow institutions to meet the credit needs of the U.S. economy. I am therefore supportive of this notice of proposed rulemaking. I look forward to the public comments on the proposal. The proposed special assessment would be applicable no earlier than the first quarterly assessment period of 2024, providing institutions time to prepare and plan for the special assessment, and payments would not begin until the end of the second quarter. Finally, I would like to thank the FDIC staff for their very thoughtful work on this proposed rule. That concludes my statement, and I'll turn to Vice Chairman Hill.
Thank you, Chairman. In my view, at a high level, the banks who experienced the largest outflow of deposits following the failure of Silicon Valley Bank are generally the banks who benefited most from the systemic risk exception, and the banks who experienced inflows of deposits are generally the banks who benefited least. The biggest problem with using total uninsured deposits as a metric to gauge who was helped most by the systemic risk exception is that both the banks who experienced the greatest outflows and the banks that experienced the greatest inflows all had high volumes of uninsured deposits. The banks who would pay the most under the proposal, both in absolute terms and relative to their regular quarterly assessments, were generally the biggest beneficiaries of the flight to safety following SVB's collapse. Under the proposal, the 5 banks who would pay the most relative to their regular quarterly assessments, who combined would pay nearly half of the entire special assessment, all experienced deposit inflows immediately after the SVB failure. For those reasons, I plan to vote against the proposal. I look forward to reviewing the comments. Thank you to the staff for all your work, and I appreciate all the engagement with me on this over the past few weeks. Thank you.
Thank you. Director McKiernan.
Thank you. Thank you, Mr. Chairman. I do have a few thoughts to offer, and I'll submit a longer written statement for the record. First, I'd like to thank the staff for their work on today's proposal. I also would like to acknowledge all the staff's tireless work since early March. The staff's stamina and grace under pressure have been a testament to the strength of the agency and public service more generally. As for today's proposal, I support several key aspects of the proposed special assessment. I agree with the proposed exclusion of community banks. I agree more of the special assessment should be paid by those banks that were most exposed to the contagion risk that could have been triggered by the wind down of SVB and Signature in a normal course. I also agree that a bank's exposure to that contagion risk depended in part on its reliance on uninsured deposits. In my view, however, the special assessment could be better calibrated. All else equal, a bank was more exposed to contagion to the extent it relied on uninsured deposits to fund a larger share of its assets, and also to the extent it was less well capitalized, taking into account unrealized losses on securities. I would therefore consider distinguishing between absolute and relative measures of uninsured deposits, and also between banks based on their capital levels after adjusting for unrealized losses. On a related note, the preamble to today's proposal sometimes suggests that the primary purpose of the FDIC's March 12 use of its emergency powers was to prevent uninsured depositor runs. Some in the press have even characterized the FDIC as having implicitly backed all uninsured deposits. However, the FDIC does not have the statutory authority to backstop all banks' uninsured deposits, whether implicitly or explicitly. I supported the March 12 actions to mitigate a wider range of serious adverse effects on economic conditions and financial stability that could have arisen out of winding down SVB and Signature in a normal course. As discussed in greater detail in my written statement, the legal and practical constraints imposed by the FDIC's statutory least cost resolution requirement put the FDIC on a course to liquidating the failed banks through a series of asset sales and deposit payouts instead of executing whole bank acquisitions by stronger banks. The contemporaneous and sudden failure of 2 large banks was on its own a sudden shock to public confidence in the banking system. That adverse effect was likely to have been magnified by the lost going concern value as a result of the liquidations, the disruption to the lending and other markets served by those banks, the dissipation of asset value during the liquidation process, and the missed payroll, bankruptcies, and other fallout arising out of large amounts of uninsured depositors' working capital being locked up and subject to risk of loss. Even more importantly, the surest way to reinstate public confidence in the banking system has historically been for the private sector to stake a meaningful investment in a distressed bank. A liquidation would have missed out on that opportunity. My March 12 vote was intended to mitigate these serious adverse effects by exempting the resolution of SVB and Signature from the least cost resolution requirement so as to facilitate subsequent sales of the failed banks that hopefully would preserve their operations and franchise value. As I have said before, going forward, any decision to use the FDIC's emergency powers should be approached skeptically, taking into account the unique facts and circumstances of the time, and with careful attention to the implications for the future. Thank you, Mr. Chairman.
Thank you. Director Sue?
Thank you, Chairman Grunberg. I support the recommended approach described in the NPR on special assessments. I do so for 3 reasons. First, it is fair. The invocation of the systemic risk exception for SVB and Signature Bank prevented runs by depositors at other banks. The more uninsured deposits a bank had, the more of a beneficiary it was of the government's action, and the more of the cost of the special assessment it should bear. This is intuitive, simple, and fair. Second, the recommended approach establishes a healthy precedent. While the FDIC has invoked the systemic risk exception several times in the past, this is the first time a special assessment has been required following a systemic risk determination. Rather than simply defaulting to assessing all banks as is done for the Deposit Insurance Fund generally, the board is heeding the FDIC Act by considering who benefited from the systemic risk exception and adjusting the special assessment accordingly. Third, the recommended approach supports a diverse banking system by minimizing costs on community banks, which are critical to local economies across the country. For these reasons, I will vote to approve staff's recommendation to issue the NPR. I want to give special thanks to FDIC staff for their thorough analysis and development of the NPR within the accelerated timeframes. Thanks.
Thank you. Director Chopra?
Thank you so much, and really also want to thank everyone who's really actively engaged on all of these questions. I think they're very important, and I want to echo what Director McKernan said about our staff really working under fire and getting through it, and it's really a sign of great public service. I do want to ask a question, which is the proposed special assessment uses uninsured deposits as the assessment base. I wonder if you could share a little bit more about the relative outflows of insured deposits versus uninsured deposits that we saw in the immediate aftermath of SVB's failure.
Sure, thank you, Director Chopra. So right now we've just received the call report information. I think we'll be able to better answer that after related to the QBP. What we do have is we have the H8 data, which shows total deposits. It doesn't break it out by insured versus uninsured, and we know that total deposits declined in the banking industry. I forget by how much, but by a certain level following the 2 failures. And again, I think we'll be able to answer that question more thoughtfully and thoroughly after analyzing the call report data for first quarter.
Yeah, and I think for those of us who are closely involved in supervision, I think we are seeing some data and some signs that, the movement of insured deposits was, of course, in many ways quite stable and a sign of how important FDIC insurance is, and that really a lot of the movement was from those uninsured deposits. And I know you addressed this a little bit in your presentation already, but over the last 2 years, the banking system has shown $540 billion in net income. I wonder if you could talk about the proposed special assessments projected impact on projected bank profitability and bank capital levels.
We estimate that the effect to earnings will be 17.5% on average. That is the 4-quarter average from based on the 4-quarter average of earnings from 2022. The impact to capital is about 61 basis points or less than 1%. So negligible.
And I would also note that is specific. You're talking about the industry net income, and so that is
That's right.
17.5% reduction is a 1 quarter, and it's only relative to those institutions. So that's an important clarification for everybody else. Obviously, it would be 0, and the net effect really is the 15.8 billion, and that would come out at 1 quarter. So to that point, it's a small well, I don't want to say small, it's large, but I mean, at the same time, it's certainly something that seems manageable.
And could you just share one or two more details about how we came up with the number of quarters that the assessment would be paid over? I think that is something that is pretty important in the proposal.
Sure. So there's a couple, we came up with 8 quarters, and again, it's open to comments, so we're interested to hear what the public has to say about that. We think that 8 quarters does a couple things. One, it actually will, it provides enough time for banks to maintain liquidity, because that's really what we think the effect would be. So that spreads out the liquidity, any liquidity effects. So we think that helps mitigate any liquidity concerns. The other thing that does, it also allows more time for our estimate to firm up over time of the losses. So that also allows us to, if losses were to move lower, then we would be able to terminate as we've mentioned, we'd be able to terminate the assessments, the special assessment, to reflect that lower cost. So I think it does both things. It actually allows for, again, for institutions to manage their liquidity, and also allows for us to have some time for the loss estimate to firm up.
Well, great. Again, I appreciate all the work, and also just to, briefly comment on Director McKernan's statement. I do think his point about the dependence on uninsured deposits is one we should be thinking about across the board, including our own supervisory program, and even if appropriate, regulations. I'll submit a full statement. I'll just read a part of it. 2 months ago, Silicon Valley Bank and Signature Bank failed. Most Americans have never heard of these two very large banks. While they weren't massive mega banks, the actions taken by the federal government make it clear that their failure had far-reaching consequences for the broader financial system. Both banks were deeply dependent on uninsured deposits. Those are the accounts that exceed the deposit insurance limits established by Congress. This means that their failure wouldn't have been all that expensive to the FDIC, but the rapid flight of those uninsured depositors throughout the banking system raised very serious concerns that more large banks would crumble as contagion spread. That's why in March, the Treasury Secretary, at the unanimous recommendation of the Federal Reserve Board and the FDIC Board, invoked the statutory systemic risk exception, and to protect those uninsured depositors. Now, it is true the bank shareholders and unsecured creditors lost their money. The boards of the banks and senior management were removed, but uninsured depositors who would have otherwise taken a hit were made whole in order to stabilize the system. And that current estimated cost to the FDIC's Deposit Insurance Fund is $15.8 billion. So that's why today we are proposing this special assessment to require the banking industry to pay for that extra cost. And I support the proposed special assessment framework because it makes large banks, the firms that overwhelmingly benefited from this action, foot the bill. The law requires that we initiate a special assessment to recoup these funds from the industry with due consideration to the types of firms that benefited from the emergency action. That's why we're proposing a special assessment on banks' uninsured deposits above $5 billion. About 95% of the assessment will be paid by banks with $50 billion or more in assets, as the chairman mentioned, including a $9.5 billion charge on the largest too-big-to-fail banks. Many of these banks saw a surge in new accounts since many uninsured depositors assumed that the biggest of the big banks essentially get free, unlimited deposit insurance because they will always find a way to get bailed out, and we do need to change that. The assessment is a small fraction of the banking sector's net income over the last 2 years, And importantly, more than 4,500 banks, including all of our nation's community banks and many mid-sized banks with limited uninsured deposits, will not pay at all. So I'm looking forward to reviewing all the comments we receive, including the payment schedule, the formula, and more, but the principle of making sure that those who were large who benefited should pay. We have a number of open questions on the table about whether regulators across the board have the courage to learn from this so we can avoid getting into situations that require emergency powers. And there's a promising sign here. The Federal Reserve Board and the FDIC recently published autopsies on what went wrong. But both firms were obviously mismanaged, but it was clear that supervision and deregulation contributed to the mess. And the core assumption that we could relax the oversight and the rules on large, domestic, systemically important banks without posing risk to the financial system turned out to be a really bad bet. So I again want to thank everyone who helped shape this proposal. I'm looking forward to the comments, and I'll look forward to voting yes. Thanks, Mr. Chairman.
Thank you, Director Chopra. Are there any other comments or questions from the board? If I may, I'd like to thank all the board members for their engagement and thoughtful comments on this proposal. May I have a motion with respect to the special assessment notice of proposed rulemaking?
So moved.
Thank you. And a second? Second. Thank you very much. I'll call the roll, as it were. I vote aye. Vice Chairman Hill? Nay. Director McKiernan?
Nay.
Director Sue?
Aye.
Director Chopra?
Aye.
Thank you very much. The motion is adopted. That concludes the discussion agenda for today's meeting. Is there any other business that any member would like to raise? If none, the meeting is now adjourned. Let me once again thank the staff really for their very thoughtful work on this proposal. Thank you all very much.
Thanks, everyone.